If you trade, chances are you've blown an account or lost your patience watching price action like this. So, in today's video, I'm going to help you guys understand how to predict and identify low probability price action so that you guys can save your capital and your time, right? So, without wasting any of your time, let's go over the 4 steps that I take to identify and or predict poor price action to save my time and energy. So the first rule is to check what happened during Asia and London sessions. And this is for people who trade futures during New York session, which is 9:30 Eastern in the morning to 4 p.m. Eastern. And that's the most common session to trade futures, at least with ES and NQ. And that is when you'll see the most volatility on average and best price action. But this is the thing, we're going to go back to a very simple concept of expansion and consolidation, right? And what you'll see oftentimes in any uptrend or downtrend is that you're going to have expansionary moves, and then that's going to lead to some consolidation. And whether we end up continuing or reversing, that next expansionary move is going to have some consolidation most likely coming before it. Now, why that's important is because say that you watch the market close at 4 p.m. and then we just pump all through the overnight session, right? So through Asia, through London, we're having this expansionary move. What you can then expect a lot of the time is that the next New York session is going to be a consolidation period, aka worse price action, less opportunities, less volatility. The reason that is very simple, because when the market expands, it needs to be followed by consolidation. And oftentimes we'll get the expansion moves or trend moves during New York session, right? But if we get one overnight, especially if it's extreme, right? You're talking a few hundred points on NQ overnight, either up or down. Oftentimes, what you're going to see is consolidation and a little less volatility during New York session because we just made an expansionary move overnight. So that's the first step. Real quick, if you're enjoying this video so far, make sure to like and subscribe for a ton more educational content and trading recaps. Enjoy the rest of the video, guys. Now, the second rule is to watch higher time frame imbalances. So right now we're on the 4-hour chart, and the reason this is significant is because usually to have a good tradable market, you're going to want to see imbalances being traded back into or even inverted if you're talking about fair value gaps in some way, shape, or form, right? So the last several days we've had pretty poor trading price action, and the reason is, if you look, we haven't gotten any solid pullbacks into any of these open 4-hour gaps, right? We continue to leave gaps open. We left a new week opening gap completely open, and we have all these 4-hour bullish gaps that just have not even been traded back into, right? So when you see something like that, the market's overextended, but you don't want to blindly short, right? Because that's stupid. You just be like, why would you blindly short this? But then you also don't really have anywhere to long. So during all of this, run up, and I've been witnessing it myself because I've tried to trade some of it and there's just not been any opportunities. If you go to the lower time frames, what you're going to see is very choppy, slow, low consolidation grinds up, which isn't going to offer you a good environment for trading. Now, maybe if you're in longs for swing trades, sure, of course. But if you're talking about, scalping, some intraday volatility, it's going to be awful. So when you see imbalances just being left behind and not traded back into at all, it usually means that the volatility hasn't even picked up enough to bring us back down to those. So that's where you see this just slow, continuous grind up with not many opportunities, right? And so something more ideal that might have given us, a better trading environment, like let's repath this out, right? So maybe we get like that, we have this huge move up, then maybe we come down, consolidate in here, then we leave another back. Like, I kind of just lost my train of thought drawing the stupid squiggly line, but the point is, you want to see imbalances being tested. And when there are so many being left open behind, it's probably not going to give you the best trading environment. Now, I'll just immediately switch this to the third rule, which is very simple and kind of related, but it's a little different, and that's to watch lower time frame imbalances, right? So let's go to the 1-minute chart and you guys will see what I mean. Now, the reason you guys want to do this, okay, and it's very, very important, but basically, if you look on the lower time frames, like so, and you see that we are not really creating any imbalances, and then when we do, they get immediately disrespected, so aka like fair value gaps. that's not going to be a high probability environment to trade. Now, we'll just go through an example. So if you go into kind of replay mode here, you can see like this was New York session today, right? And throughout the entire day, we just weren't really creating fair value gaps because there were so many wicks, right? And then when we got one, it would get ran and disrespected immediately, right? It would get inverted immediately. But when you see stuff like this, just a ton of wicks, no imbalances being formed. What the market basically is in a state of is it lacks structure, right? There is no even lower time frame solid structure being put in at this point, right? And you can see all throughout here too, like what, like where are the fair value gaps? There are none being created, right? So you don't have much to go off of. I mean, so much of ICT trading, especially my STIM model, sweep tap inversion momentum, has to do with fair value gaps. And so when you're in a scenario where the market is so choppy that we're barely creating any fair value gaps because of all of the wicks, that means that the market is probably in a low volatility state and isn't going to make some crazy range break anytime soon that you can take advantage of for trading, right? So those are three ways you can tell. Now, the fourth step is this website called Forex Factory. And basically, there are a few things you can use this for, and it can help you out. So the first thing is no news Mondays. A lot of people in the ICT community swear by not trading them at all. I don't not trade them, but I do size down typically, and I genuinely just don't find as many opportunities on no news Mondays. So there is some truth to them not being that good to trade. Although, like I said, I still trade them from time to time. But basically, if you go back to October 27th, that was Monday, it was my birthday, and you can see we had no red folder USD news. So that means that there isn't going to be any news. There isn't going to be much volatility, most likely on No News Mondays. Another way you can find some low volatility days that you want to avoid is, so say today we had the Federal Reserve funds rate, the Fed funds rate, and the FOMC statement both at 2 and 2:30, okay? So this morning, leading up to that, the price action was atrocious. It was very bad, very little volatility, almost no scalping opportunities for my system or for many ICT traders at all. And that's because the whole market is waiting on this big piece of news. So on these type of days, when you've got the Federal Reserve going in the afternoon, or maybe the day before like a big inflation report, those type of days tend to be a little slower as well. So as long as you keep all this in mind, you will be able to do better at avoiding poor and low probability price action. Once again, none of these rules are ever going to be 100% accurate, right? It's not like if we expand in Asia, we're definitely chopping all of New York. Or it's not like if we leave a big 4-hour bullish gap behind on the chart, you're not going to find any opportunities. That's not what my point is. My point is just that these things can help you identify. And if all of them coincide, especially, which is actually what's happened this week, then you can pretty much infer that we're not going to have the best price action for trading, especially because low volatility environments can be very hard to get value out of for scalping, right? So that's kind of the point. I hope this helped you guys. And just a reminder, like some people try to trade and go and do it with the attitude that they need to make money every day, that they need to be green every day. And that type of mentality will kill you. That's the type of mentality that's going to force you to stay on during this type of price action. And it's going to force you to take low probability setups, force trades, and it's just going to lead to bad outcomes. And instead of ending the day green, you're going to either waste all your time or blow your accounts. So you're literally setting yourself back by trying too hard to trade this type of price action. All right. So I hope that helped you guys. Like I said, if you are still watching this, you're probably a serious trader. And if that's the case, make sure to like and subscribe. I post a ton more content all the time to help you all become better traders, and I enjoy doing it. I also post recaps and other, stuff like that so you guys can see me trade. And if you are interested, make sure to join my free trading Discord. It is completely free. No credit card, no email, no nothing. It is linked to my YouTube bio. I go live in there. I trade with my community, and I get back to all you guys. Remember, I'm a small creator, so I make time to get back to everyone who reaches out to me. And yeah, with that being said, I hope this video helps you guys, and I hope you enjoyed it. I'll catch you in the next one. Peace.